this October is going to be the crash. What I would say is that the backwardation of spot over futures has actually declined now to around about $1. So it's come way, way down. It still indicates that there is a shortage. In other words, a squeeze on those who are short. Because the problem is that the vast majority of the silver in the LBMA vaults is ETF silver. Whether it sort of goes up 5%, falls 5%, is completely immaterial. The thing to bear in mind is that the value of gold is relatively constant over long periods of time.
Alasdair Macleod, head of research at GoldMoney, explained that the recent volatility in silver reflects a deepening shortage in physical supply, rather than simple market speculation. He noted that backwardation, where spot prices trade above futures, has narrowed from over $3 to around $1, still signaling tightness and stress among short sellers. With lease rates soaring to 100%, liquidity in physical silver is drying up, mainly because most LBMA vault holdings are tied up in ETFs. Even Indian silver ETFs have suspended new share creation due to a lack of available metal. Macleod emphasized that gold and silver must be viewed as money, not commodities, serving as final settlement outside the fiat system. Their real value lies in counterparty-free security amid worsening global monetary instability. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
Well, there's no doubt there's been a huge great squeeze. I mean, you can see this in lease rates, and basically, someone who's got an obligation to deliver physical metal tomorrow, and if he hasn't got it, he's got to go and lease it from somewhere. The lease rates have shot up. I mean, typically they were sort of up to 30, 40%. And there's some reports of them going up to 100% and more, basically saying, there's no more left to lease. The other thing, of course, is that we see a backwardation, which by definition is when the spot price is above the futures price. And people got very excited with that, being over $3 at one stage, which of course would prompt arbitrage. I mean, people with silver sitting in COMEX warehouses would think, okay, we'll ship some of that over and make on the arbitrage. So there've been lots of stories about that. Now, how true they are or whatever, I honestly don't know. I'm sure there's a bit of it, but it's probably exaggerated. What I would say is that the backwardation of spot over futures has actually declined now to around about $1. So it's come way, way down. It still indicates that there is a shortage. In other words, a squeeze on those who are short. Because the problem is that the vast majority of the silver in the LBMA vaults is ETF silver. And the other thing which puts additional pressure on the system is, of course, people look at silver, they see silver going up, they probably think they've missed gold, and therefore the silver is a cheap way in. So they run out and buy ETFs. ETFs have to source the metal. And I think it was last week we heard that a number of ETFs, silver ETFs in India, suspended share creation because they couldn't source the silver. And I think on that basis, I mean, really what we see is that silver is too cheap for these deteriorating monetary conditions. That is absolutely clear. It is therefore going higher. So really, I think you've got to take, if you like, a more sensible view as to actually why it is that you own gold or silver. And the only justification for that, because they are at a premium price, is because they are money. They are legal money. They are final settlement without counterparty, counterparty, as opposed to credit, which is what a fiat currency is. And if you reckon that the situation for fiat currencies is deteriorating, then that's the reason to hold on to gold. And, whether it sort of goes up 5%, falls 5%, is completely immaterial. The thing to bear in mind is that the value of gold is relatively constant over long periods of time. It is the value of fiat currency which alters. And that has been declining very significantly, particularly since 1971, when the Bretton Woods Agreement was abandoned. So in dollar terms, I mean, you had $35, that was the official rate, $35 to the ounce, and we're now looking at nearly 4,150. I mean, that tells you basically that a $1971 or rather the dollar today is less than 1% in its value of the 1971 dollar. And that's what you've got to keep bearing in mind. It's not a situation that is going to change in favor of fiat currencies. That's for sure. Politically, it would be impossible for any government, in the G7 anyway, to reverse the decline in their currencies. And if you see the value of gold expressed in fiat currencies rising, so long as energy prices don't rise more quickly, that's going to be good for mines. I mean, you've got to look at the input cost side as well. And also bear in mind that most producing mines, they will be managed through this. So what that means is that they will extract lower grades while they are profitable rather than the higher grades. So the idea that you can translate immediately a higher gold price into higher profits, I think you've got to temper it a little bit and just understand the reality of it. The other thing I would say is that gold is hardly owned. It's less than 0.5% of all portfolios, if you like. Mines, on the other hand, I think are a bit more owned. And what I'm looking at is this is a credit bubble. Obviously, if you've got a debt bubble, which we have, the other side of that is credit. And more importantly, this credit has been applied to inflating financial assets, particularly stocks. Now, all credit bubbles come to an end. They pop. And when they burst, they usually burst quite spectacularly. 1929, October. 1987, October. October doesn't seem to be a very good month. I'm not saying that it's going to This October is going to be the crash because, we'll look back on it and see whether that's true or not. But, when the bubble implodes, basically what people do is they will sell anything where they've got a profit in order to cover the things where they've got a loss. So that's the only caveat I would really have, I think, on investing in mines. But other than that, it's you can regard it, if you know what you're doing, as a leveraged bet on the underlying commodity. In the case of gold mines, it could be a way of you catching up if you want to speculate a bit as to, on the route to do it. But your core holding always must be the metal, because that is the one thing where there is no counterparty risk.
Alasdair Macleod explained that the true story behind gold's rise isn't about the metal gaining value, it's about fiat currencies losing theirs. Since the end of the Bretton Woods system in 1971, when gold was fixed at $35 an ounce, the US dollar has lost over 99% of its purchasing power. He argued that this decline is irreversible, as no major government can politically afford to restore currency discipline. While higher gold prices will benefit miners, Macleod cautioned that rising input costs and operational limits temper profit growth. With gold ownership still below 0.5% of global portfolios, he sees immense potential ahead, though warns that when the global credit bubble bursts, liquidity pressures could briefly hit all assets. Let's get into the interview.
I think what you have to do, when it comes to where you store your metal, and whether it's Canadian Royal Mint or whatever, is to take a view on the property rights of that country. How firm are they? Are they likely to be overturned, if you like? Now, I mean, it's an interesting point. I've had arguments with people about what happened in 1933 when, you had the executive order and basically it wasn't a gold confiscation. People say it was a gold confiscation. No, it wasn't. It was a forced submission, if you like, of your dollars for gold at that time at $20.67 to the ounce. So, if you actually had gold, and it was the banks, basically, if you had it in the banks obeyed the government. So, you lost it. On the other hand, if you had it yourself, then you just kept quiet. But it was really when it goes in the system. And if they turn around and do something like that, then you're going to lose it. The difference today is that you have, in America, there is an official gold exchange rate at $42.22 to the ounce. Now, you have to ask yourself the question, would the Americans force the banks to exchange, to take your gold and gold under the, in their custody and all the rest of it, and exchange it for $42.22 to the ounce when the market price is $4,100 or even more? I don't know the answer to that question. There may be a legal way in which they could do it. So what I would say is you don't store your gold in America. and you don't store it in a vault owned by an American corporation. And that can be in a vault abroad. So I'd say that. I think the Royal Canadian Mint I would be less worried about because Canada has some very strong property laws when it comes to property rights. I feel the same in the UK. The same is true in Switzerland. I think the other thing is that there is a big difference between banks who are regulated, and they may well be, I don't know, the regulator, through regulation, if you like. There may be a bit of a danger there. But I think by far the biggest danger with ETFs is that actually, when you own shares or stock in an ETF, it's credit. You do not possess the metal. You do not even have an entitlement to the metal. All you have is an obligation by the manager of the ETF to perform his duties on behalf of you as a shareholder. He's got the obligation and you've got the credit, if you like, the other side of that obligation. But then it gets more complicated because you don't have a direct relationship usually with the manager of an ETF. The manager of the ETF sees as his shareholder either the DTCC or Euroclear, one of those big things. And then it's Euroclear or the DTCC which has the obligation to you. Now, what this means is that in a financial meltdown, when the DTCC or Euroclear or something similar is, if you like, in the middle of failing counterparties, they are perfectly entitled by law to take what you think is yours, shares in an ETF, and deploy it as collateral or even dispose of them, bearing in mind that it's still got the obligation to you, because it'll just say, oh, don't worry, we've got an obligation to provide it, but meanwhile we're using them, thank you very much. Are you going to be like, do you like that? No, I don't think you would. So bear these things in mind. This is the difference between owning ETFs and actually owning the physical metal, either in your possession or in the possession of being stored in a vault, clearly your property, in a jurisdiction with strong property rights.
Alasdair Macleod concluded by warning investors that where and how they store their precious metals is just as crucial as owning them. He reminded that in 1933, gold was not technically confiscated, but forcibly exchanged through the banking system. Those who held it privately kept it. Today, a similar scenario could unfold through financial regulation rather than overt seizure. Macleod advised avoiding U.S.-based storage or American-owned vaults, as U.S. law still sets an official gold price of $42.22 per ounce, a legal loophole that could, in theory, be exploited. Instead, he favors jurisdictions like Canada, Switzerland, or the UK, where property rights remain strong. He also cautioned against ETFs, noting they confer only a credit claim, not actual ownership of metal. If you find this video informative, please support and turn on notifications to stay informed about our latest videos.